Good afternoon. My name is Jeannie, and I will be your conference operator today. At this time, I would like to welcome everyone to the CleanSpark Fiscal Year Second Quarter 2025 Earnings Conference Call. All lines have been placed on mute to prevent any background noise. After the speaker's remarks, there will be a question-and-answer session. If you'd like to ask a question during this time, simply press star one on your telephone keypad. In order to withdraw your question, simply press star one again. Thank you. Harry, you may begin your conference.
Thanks, Jeannie, and thank you for joining us today for the second quarter fiscal year financial results for CleanSpark, America's Bitcoin miner, covering the 3 and 6 months ended March 31st, 2025. Our press release was issued about 30 minutes ago and is available on our website at www.cleanspark.com. Additionally, the 10-Q will be filed shortly. Today's call is also being webcast, and a replay and transcript will be available on our website. On the call with me are Zach Bradford, our Chief Executive Officer, and Gary Vecchiarelli, our Chief Financial Officer. Keep in mind that some of the statements we make today are forward-looking and based on our best view of the world and our business as we see them today. The statements and information provided remain subject to the risk factors disclosed in our most recently filed annual report and 10-Q. We will also discuss certain non-GAAP financial measures concerning our performance during today's call. You can find the reconciliation of non-GAAP financial measures in our press release, which is also available on our website. And with that, I'm to turn the call over to Zach.
Thank you, Harry. Thanks to everyone for joining us today. Our second quarter of fiscal 2025 demonstrated our ability to deliver strong, consistent results across all operating environments. Because we focus on the fundamentals, cash-on-cash returns, and manage to margin rather than any single metric, our scale, strategy, and operational excellence resulted in increased hash rate, improved efficiency, higher revenue, and laid the groundwork for continued growth. In Q2, revenue increased 12% quarter over quarter and 62.5% higher than the same period last year. Gross profit reached nearly $100 million, up almost 5% sequentially, and more than 24% year over year, with a gross margin of 53%. While we reported a net loss, this was primarily driven by the quarter-end decline in Bitcoin spot price and not by changes in our mining operations. Our Bitcoin production increased slightly compared to the prior quarter, outpacing difficulty. As a result of our strong margins, our Bitcoin treasury has grown to over 12,000 as of April 30th. Average revenue per Bitcoin was up 10.5% quarter over quarter and nearly 69% year over year, while our marginal cost per coin rose, reflecting both increased network difficulty and higher nationwide power prices. We remain focused on margin and long-term performance rather than any single metric. I want to be clear on what that means. That means we do not manage to power prices, and when margins are healthy, we run through slightly elevated power prices, as long as this drives more value to the bottom line. As a result, the average power price printed higher while delivering increased gross profit. This resilience is the result of our infrastructure-first, portfolio-based strategy. By operating across 4 diverse states, Georgia, Tennessee, Wyoming, and Mississippi, we are able to balance regional price volatility and maintain consistent operations and production. The rise in power costs this quarter largely stemmed from higher prices in the Southeast, related to elevated demand charges and weather-related increases in January and February due to winter storms. Since March, we have experienced improved prices in the region. In addition, we were still implementing software to support a lower blockchain-specific tariff in Wyoming at the end of March, which is now fully implemented, and we successfully moved to lower pricing in April. As we navigated the quarter, rather than curtailing operations to chase a lower per kilowatt price, we elected to maximize production and bottom-line impact, a decision made possible by our leading fleet efficiency and strong revenue per Bitcoin. As a result, we delivered a gross margin exceeding 53%. We ended the quarter with a total liquidity position of over $1 billion. Given our scale, we've evolved from the near 100% HODL strategy adopted in late 2023 and have begun using a portion of monthly Bitcoin production to support operations. This marks a deliberate and disciplined shift, in contrast to peers who continue to fund operations through equity dilution. I want to reiterate, we concluded our outstanding ATM in November last year and have since not issued a single share to capitalize the business. We have no plans to initiate an equity offering given the accretive opportunities available to a company with a strong balance sheet like ours. We remain committed to Bitcoin as a core long-term asset. We believe shareholder value is best served by balancing treasury growth with strategic monetization. To that end, we are continuing to diversify our capital structure, and our strong balance sheet gives us the flexibility to act decisively. As we move beyond 50 exahash, CleanSpark is well positioned to sustain long-term growth and shareholder value through focused execution and prudent capital management. We navigated this quarter not by chasing headlines, but by focusing on business fundamentals and delivering results. Some key highlights include revenue increased in both Bitcoin and USD terms, while cash overhead decreased 16% quarter-over-quarter. Although a mark-to-market adjustment to Bitcoin price created a GAAP net loss, this has since been offset by price recovery in April, and even now, Bitcoin sits above $100,000. Our scale also continues to yield competitive advantages. Fleet efficiency improved significantly from an average of 18 joules per terahash in December to less than 17 joules per terahash at the end of April, largely mitigating higher energy prices and rising network difficulty. Our power under contract is approaching 1 gigawatt, providing opportunities for future expansion. We remain on track to reach 50 by mid-2025 on our position to pursue additional capacity where we see strong ROI, whether through organic growth, site expansion, or opportunistic acquisitions. Beyond our nearly 1 gigawatt of power currently under contract, we also have an extensive pipeline of additional energy opportunities that we believe will support our growth into the future. Our Bitcoin treasury now exceeds 12,100, the third largest among public miners, and every coin was mined by us here in the United States and not bought in the open market. We've begun strategically and systematically monetizing new production to fund operations and are advancing a rigorous, accretive approach to digital asset management, all while preserving our commitment to shareholder value. Our disciplined approach to capital allows us to grow without equity dilution, supported instead by tools like our expanded line of credit with Coinbase. We're especially proud of how our fundamentals held strong amid a triple challenge: rising energy prices, declining Bitcoin spot prices, and difficulty. At quarter end, Bitcoin traded at roughly 81,000, down from 93,000 at the start of the calendar year, requiring a mark-to-market adjustment to our treasury under GAAP accounting rules. Encouragingly, these unrealized reversed by price appreciation in April. Mining difficulty rose 3.6% during the quarter, while power costs increased. Yet, thanks to improved fleet efficiency, our gross margin compression nearly matched the difficulty change, demonstrating our ability to absorb external pressures through operational gains. Our approach has never been about chasing the lowest cost per kilowatt hour. Instead, we manage to margin, making deliberate decisions, including running through higher price periods when doing so generates positive cash flow. At the core of this capability is our best-in-class power management team, empowered by advanced technology, real-time analytics, and dedicated operations staff. This deep internal expertise allows us to maximize marginal profitability across our diverse portfolio. Only a flexible load like Bitcoin mining can respond with such agility, something traditional data centers simply cannot achieve. It's one of the most compelling advantages of our pure-play Bitcoin mining model. Let me now address tariffs, a topic of increased relevance across all global markets. Thanks to proactive procurement, CleanSpark is well insulated from near-term tariff risks. The machines needed to reach our 50 exahash target are already in the US, giving us both certainty and flexibility as trade negotiations worldwide continue to evolve. While tariffs could create significant headwinds for less prepared operators, we have positioned ourselves ahead of the curve. Our scale, planning, and disciplined execution allow us to continue expanding towards our near-term targets without disruption. In fact, if tariffs persist, we may see opportunities to acquire smaller miners at attractive valuations, particularly those unable to afford next-generation hardware under the new cost structures. This is a clear example of how our infrastructure-first, counter-cyclical strategy continues to generate strategic advantages over peers. Now let's turn to growth, where our portfolio-based approach continues to deliver real advantages. Today, we operate 32 mining sites across 4 geographically diverse states. This footprint helps us mitigate weather-related risk while tapping into reliable power markets, particularly in states that are net electricity exporters. In Q2, we added more than 3 exahash of capacity in Wyoming alone. The remaining exahash needed to deliver on our mid-year target will include the completion of ground-up development in Wyoming and Tennessee, paired with the expansion and optimization of several of our operations in Georgia and Mississippi. Looking beyond mid-year, we have active projects ongoing with miners and infrastructure paid for that will push us over 57 exahash. For long-term expansion, we have secured infrastructure in hand or under contract to support growth beyond 60 exahash. We intend to put this infrastructure into use in the lowest cost and most advantageous areas. We currently view Tennessee and Wyoming as particularly attractive places to continue to grow. Looking ahead, we intend to modify how we provide growth guidance. We will reduce the use of time-bound guidance related to hash rate expansion. Our growth will remain disciplined and opportunistic, pursued where and when we see strong ROI positive potential, primarily funded through non-dilutive sources. This approach aligns with our proven countercyclical strategy and reflects our commitment to preserving shareholder value. In today's more volatile market environment, strategic flexibility is essential, and we are focused on avoiding unnecessary time-bound commitments that could undermine long-term value creation. To be clear, CleanSpark will continue to grow, and our current projects are expected to increase hash rate towards 57 exahash, and our vendor option can support growth to 65 exahash. And I look forward to providing more updates in the months and quarters to come. While we hold ourselves in high internal standards, we're also proud to be recognized externally for our growth and leadership. CleanSpark was recently ranked number 35 in the Financial Times 2025 list of the 500 fastest growing companies in the Americas. This is a reflection of our growth over the past 5 years and shows the value of our strategic discipline and our team's grit and adaptability in a rapidly evolving sector. We were also added to the S&P Small Cap 600 Index, a milestone that enhances our visibility in public markets and broadens access to our business model for institutional investors. Following our inclusion, institutional ownership in our common stock increased to nearly 64%, a strong vote of confidence from some of the world's most respected asset managers. While others may focus on headlines, we remain committed to substance, building a resilient, vertically integrated Bitcoin mining company grounded in operational discipline and long-term vision. As the only remaining public, pure-play, vertically integrated Bitcoin mining company, we're building an enduring business, applying traditional disciplines to one of the world's newest industries and most important assets. Because of the investments and decisions we have made, we are well positioned to capitalize on the improving landscape. We've established a strong track record of market leadership. CleanSpark has consistently led with foresight. We've invested early in infrastructure. We pioneered a capital strategy that will minimize dilution. We secured ASICs through countercyclical buying, and now we're setting the standard for responsible digital asset management. Each of these moves has delivered real, measurable value, and we are confident our latest steps now and in the future will do the same. I often use the term escape velocity to describe CleanSpark's current trajectory. In a business context, it means we've reached a critical inflection point where our scale, operational performance, and financial discipline combine to generate sustainable, positive cash flow well in excess of our cost. Our operations, anchored by market-leading data centers and energy infrastructure powered by best-in-class miners, are not only profitable, but also self-funding. This marks our transition from growth dependent on external capital to a model capable of being driven by internally generated returns. It also reflects a deeper momentum. We are expanding our lead in operational efficiency, capital stewardship, and market adaptability. And that separation from the pack is accelerating. As the last pure-play Bitcoin miner, we are creating a durable competitive advantage and reinforcing strong market fit. Our role as a flexible energy load adds even more strategic value, enabling us to support power grids while scaling nationwide. Escape velocity for us means optionality, the ability to invest in ourselves, adapt to changing conditions, and compound growth without compromising our core. We are achieving disruption through discipline, and we're just getting started. Finally, I want to recognize the incredible work of the CleanSpark team across the country. Your execution, dedication, and belief in our mission continue to set us apart one block at a time. With that, I'll turn it over to Gary for a closer look at the financials. Gary?
Thank you, Zach. As Zach mentioned, our second fiscal quarter was solid for CleanSpark, despite some of the challenges we faced. Let's look at the numbers. Our revenues for the quarter were $181.7 million, an increase of $69.9 million, or 62.5% over the same quarter last year. We produced 1,957 Bitcoin for the quarter, 74 less than the same quarter last year, only 3.6% fewer, despite block rewards being cut in half in late April 2024. We are almost at the same number of Bitcoin produced as pre-halving due to our increasing exahash and increased fleet efficiency from our best-in-class miners. It is also important to note that our average revenue recognized per Bitcoin produced in Q2 was $92,811, which is an increase of approximately $38,000 or 69% over the same quarter last year. When compared to the immediately preceding first quarter, our revenues increased 12%. As Zach has pointed out, this is primarily due to the increase in average revenue per Bitcoin and growing hash rate. Looking at our margins, our gross profit increased by $18.8 million year over year, with a profit margin of 53% for this quarter. When compared to the immediately preceding first quarter, our gross profit increased $4.3 million, or 5% during the periods. This quarter, we recognized a net loss of $138.8 million, a change primarily driven by the decrease in the mark-to-market adjustment in Bitcoin value between December 31st and March 31st. Our adjusted EBITDA was a negative $57.8 million for the quarter, also driven by the mark-to-market adjustment. However, I want to point out that when normalized and adjusting for the mark-to-market item, our operations produced approximately $70 million of positive EBITDA. On a normalized basis, $70 million represents 39% net margins. which is representative of the cash-on-cash returns we seek. Notably, our marginal cost per coin was approximately 42,600, a 26% increase over the first quarter. The increase in our marginal cost per coin can be attributed both to an increase in mining difficulty as well as rising power prices. Our average cost per kilowatt hour increased during the quarter to 6 cents. And as Zach mentioned, this was a result of intentionally managing to a margin rather than to a specific cost per kilowatt hour. I want to again emphasize, we manage our operations based on margin rather than to a specific unit price of energy. We ended the quarter with $97 million in cash and 11,869 Bitcoin, representing a fair value of approximately $980 million. In total, the company had almost $1.1 billion of liquidity at the end of Q2. When it comes to our Bitcoin treasury, I want to note one change on our balance sheet. For the quarter ended March 31st, you will see our Bitcoin value split between short-term and long-term classifications. This classification meets accounting requirements as the company expects to hold at least 15% of its treasury in deep cold storage for at least the next 12 months. The portions classified as short-term will be to sustain growth and for strategic treasury purposes. I'll have more on that in a few moments, but it's important to note that all Bitcoin on the balance sheet as of the quarter end remains liquid and available for us to utilize. Total debt as of the end of the quarter stands at $64.7 million. Note that this amount is net of debt issuance costs of approximately $16 million, which were incurred as part of the company's $650 million convertible transaction in December. As a reminder, this issuance has a 0% coupon and an effective conversion price of $24.66 per share. Looking deeper into the balance sheet, there are some other details I would like to highlight. Our capital strategy has matured significantly, enabling us to pursue non-dilutive funding options that support both our operations and long-term growth. CleanSpark has achieved escape velocity. We have the ability to self-fund operations and grow our Bitcoin balance while enhancing shareholder value. In April, we were proud to expand our relationship with Coinbase through their Bitcoin collateralized lending program as part of our broader strategic approach to capital management and increasing our line of credit with Coinbase Prime to $200 million. Our Bitcoin holdings of 12,101 at the end of April represents over $1.2 billion at today's Bitcoin price, more than reversing the prior quarter's mark-to-market unrealized losses. We believe this is the right time to evolve from a nearly 100% HODL strategy adopted in late 2023 to using a portion of our monthly production to support operations. This represents a meaningful strategic distinction from many of our peers who continue to rely on equity dilution to fund operating costs or increase leverage to grow their Bitcoin reserves. We view our approach as deliberately strategic rather than ideological, particularly now that we've reached our current scale. While we remain committed to Bitcoin as a long-term hardened asset, we believe a more effective way to increase shareholder value is through a balanced approach between monetizing new production and growing and monetizing our treasury. As part of this strategy, we tend to further diversify our capital stack. As we have consistently emphasized, our focus is on ROI and our ability to make real-time decisions in the market. Given today's market environment, we view the revolving line of credit as the most efficient and responsible path to supporting accretive growth, and our strong balance sheet positions us to take full advantage of that opportunity. It is our intention to use proceeds from the revolver for accretive CapEx purposes. Furthermore, we are conscious of adding leverage to our balance sheet and expect that we will rapidly pay down the line of credit and not hold high balances for extended periods of time. We intend to manage the business on a net debt basis to ensure proper liquidity to cover all debt obligations. On the topic of CapEx, all infrastructure and machines required to get to 50 exahash is fully funded. I want to take a moment to discuss our investment in growth past 50 exahash. We have paid approximately $100 million towards additional infrastructure supporting almost 200 megawatts. We have also paid approximately $135 million for state-of-the-art ASICs, which equates to approximately 7 exahash above and beyond our 50 exahash target. And importantly, the vast majority of these are already stateside. On the topic of tariffs, I'd like to discuss a unique transaction we recently completed. In April, we exercised a portion of our option with our vendor for 13,200 of the latest generation miners. The total amount due under this exercise was approximately $76.6 million. However, we negotiated a favorable payment arrangement using Bitcoin, whereby the vendor accepted Bitcoin as consideration with an exchange rate at 150% of Bitcoin's spot price on the date of payment. This means we transferred 691 Bitcoin with a fair value of approximately $66.7 million, or a spot rate of $96,600 per Bitcoin. This resulted in savings of approximately $10 million as the vendor applied a Bitcoin price of $110,941, or 15% higher than spot, towards the purchase. Additionally, as part of the transaction, we received a free call option to repurchase 691 Bitcoin at the $110,000 price on a date later this fall. We expect to exercise this option if the fair value of Bitcoin is greater than this amount. If the fair value is less, we essentially have locked in our miners at a lower price and more than offset any potential tariff impacts. Now I want to provide an update on our Bitcoin treasury efforts. On our past 2 calls, we provided a brief glimpse of how we have been building an institutional-grade digital asset management function. As of today, we're in the final stages of negotiating and executing ISDA agreements, which will govern how trades will be settled and the amount of collateral we will need to post. Additionally, we have identified strategies complementary to our operations and capital strategy for the first phase, in which we have referred to as the crawl, walk, run process. Overall, when it comes to execution, we're in the crawl phase, and we'll soon be implementing our strategies to rapidly advance to the walk phase and continue scaling from there. I will tell you, however, that based on the modeling and indicative pricing we are monitoring in real time, the opportunity is quite exciting. If it seems as if this has taken some time, that's right. This has been a very deliberate process. We've been engaged in rigorous evaluation of treasury strategies and the counterparties we choose to work with. We are also very conscious of collateral requirements in order to maximize returns and minimize counterparty risk. Despite our deliberate pace, we have led the rest of the industry when it comes to establishing this function, performing proper diligence, and are now prepared to maximize performance of our Bitcoin treasury. In many of the conversations we've had with potential counterparties, the message has been the same. We are the first public miner to have a professional and thorough RFP and due diligence process. We appreciate the partnerships we have developed and the willingness to lean into this due diligence process. Together, we all agree reducing counterparty risk is important for the industry as a whole. To those partners we have selected at this time, we look forward to working with you. As we enter our next phase, growing beyond 50 exahash, we believe CleanSpark is uniquely positioned to deliver sustained, long-term shareholder value as we continue to execute on our strategic vision and evolve. With that, I'll turn the call back over to Harry to open the floor for questions.
Thanks, Gary, for that detailed financial overview. We will now open the floor to questions from the analyst community. Operator, please provide instructions and manage the queue for the Q&A session.
At this time, I would like to remind everyone, in order to ask a question, press star, then the number 1 on your telephone keypad. We'll pause for just a moment to compile the Q&A roster. Your first question comes from the line of Mike Colonnese with H.C. Wainwright. Your line is open.
Good afternoon and great quarter from an operating standpoint, guys. First one for me, maybe to Zach. It'd be great to get your outlook for the growth in the network hash rate in 2025 and how you're thinking about CleanSpark's market share within that context, especially now with the tariffs and some of your peers pivoting over to HPC AI.
Hey, Mike, great question. Thanks for joining the call today. What we've seen, I think, is a little bit of a plateau effect that's kind of interspersed with some growth. And so, I think that the limited growth we've seen on the network is likely due to upgrade cycles that are naturally occurring in the space. But I don't know that we're seeing a lot of meaningful new investments, which is a great thing for us. We're sitting at about 5% of market share and growing. And, our intention is to maintain and grow that market share. And we think, all things considered, with how we're monitoring kind of global movement going, that we're incredibly well positioned to do so.
Great. Appreciate the color, Zach. And maybe one for you, Gary, if you could just talk about how you envision the digital asset management team generating shareholder value over time and how that treasury approach differentiates you from some of your peers out there.
Yeah, thanks for the question, Mike. So we've been, as I mentioned in my comments, we've been hard making sure that we select the right counterparties and partners on this journey. And we feel confident that we've really chosen the best of the best. And I'll tell you, there's a number of strategies that we're looking at. The ones you've heard me talk over the past really couple of years is something as vanilla as covered calls. Let me share some information that I pulled this morning because we monitor this in real time, and I really can't think of any other word to use other than these premiums are rather juicy. I know it might be a little hard to model juicy sometimes, but let me give you an idea of what excites us here. Bitcoin's trading around 101,000 right now. So if we were to issue covered calls at the money, so with a strike price of 101,000 1 week out, that's a premium of a little over $2,400 or 2.4%. Annualized, that's 97%. Now, naturally, we wouldn't put the entire Bitcoin balance at risk at the money, but at least a covered call at the money would allow us to always stay ahead of spot by at least a couple points. And we've always been confident we'd be able to do that with this basic strategy. And since we're sellers now of Bitcoin to help pay for operating expenses, that's going to be very important for us to always stay ahead of spot. Additionally, when you start to ladder this out, I mean, if you're even to look at, a 2-week strike at 101,000, it's like 3.4%. You go to 102,000 or so, $1,000 out of the money, it's about 3%. So again, those are pretty interesting premiums, and again, juicy yields for such short-dated options. But that's just one example of what we're looking at, and ultimately, this is going to generate what we're internally calling this flywheel, this treasury flywheel, that will allow us to generate some cash that we can then have optionality and flexibility as to whether we then further reduce the reliance on selling a production and apply towards operating expenses. We could pay down debt, or we could roll it into other instruments and maybe even into Bitcoin.
Thank you for taking my questions, guys.
Your next question comes from the line of Greg Lewis with BTIG. Your line is open.
Yeah, thank you and good afternoon, and thanks for taking my question. I wanted to follow up on Mike's comment, kind of questioning, but in a different way around, CleanSpark. You guys have kind of stayed true to Bitcoin mining and have really kind of moved this forward as other companies explore other opportunities elsewhere outside of Bitcoin. Has that had any impact? These other less appetite for rigs from some of these other larger players, has that had any noticeable impact on the pricing of mining rigs? And just given the fact of CleanSpark and a couple others real focus on just Bitcoin mining, I imagine that pretty much any rig OEM is looking to really increase or build that relationship with you. I mean, is that something that, I guess in that question really, what is happening with rig pricing, just given the lack of the slowdown in buying from some of your larger competitors? Has there been any impact?
Yeah. Hey, great question. I appreciate you joining the call. It has. I think it's what created the opportunity for that unique transaction that led to a 15% decrease into what was already an industry-leading best price. And so, we've always prided ourselves for the capital that we're deploying, especially to rigs, as being market-leading. So we've always attempted to have the very best price that rigs are being purchased at. But I think what we're seeing now is because there are less buyers in certain pockets of the market, it's a supply and demand question that we have the answer to. And so it does give us a great opportunity to acquire more rigs at a lower cost. So we are seeing some. I think that, this 15% discount down is probably step one of many, because I think, if you think at how this market really works, they have to print chips, 6 to 9 months in advance, then assemble it into the final units that ultimately then get delivered to customers. So this slowdown in buying that's happened, I believe the shock to the miner and ASIC market has not yet been felt. And I think we'll continue to see prices pushing down even on, potentially even the next generation beyond this one. I would expect to see price improvement that we would stand to benefit from greatly.
Okay, great. Super helpful, Zach. And then Gary, cognizant of the announcement to kind of be, covering our expenses through Bitcoin mining sales. If I were to just look at, Q1, it looks like your, kind of OpEx, between SG&A and services, et cetera, is like in the low $30 million range. Basically in April, you sold, it looks like around 35 million of Bitcoin. Without pigeonholing you, is that did we just cover the CapEx for the quarter with a month of sales, or put another way, did we just cover the CapEx for Q2 with April sales? Is that a fair way to think about it, Gary? Yeah.
Yeah, this is how I would think about it. You essentially take the inverse of our margin, and that's ultimately what we have to pay. I mean, obviously plus overhead, but that nut is monthly about $35 million, give or take, right? Because you have some payables that come and go. So, but on average, it's about $35 million a month. Anything that we raise above that could go towards CapEx or servicing the line of credit. As you may have noticed, at least on the April monthly production, we've drawn down a little over $100 million for the line of credit, 100% of which is being used for accretive CapEx. And obviously, we'll have to pay down, we'll have to sell some Bitcoin to service that. But with Bitcoin price rising and the fact that we have more exahash coming online, that just means that we have to sell less Bitcoin every month just to cover the monthly nut.
Yep, no doubt. All right, super helpful. Thank you very much.
Thank you.
Your next question comes from the line of Brian Dobson with Clear Street. Your line is open.
Yeah, thanks very much for taking my question. I think avoiding dilutive capital raises is pretty impressive, and given where the shares are, probably a smart thing. As you think about the valuation of your public equity, would you ever consider using some of your HODL to repo the shares?
Yeah, I'll take that one, and Zach, chime in if you have any input. I'll tell you, look, we look at all levers available to us. I mean, that's why we're a public company, right? And as we mature and we talk about building out this capital stack, there's other instruments and new instruments that become available to us. And I'll tell you right now, when we look at the fact that our book value is greater than our market cap, that really nudges us towards not utilizing equity. And so when you have $1 billion plus sitting on the balance sheet of Bitcoin, we just think that that's a whole lot easier capital and, of course, lower cost capital to access. So that's just how we think about it. I mean, if we were to get a premium on the equity, we would consider that. But at the end of the day, driving shareholder value remains one of our top priorities. And the way that we're doing that is to continually grow the balance sheet by paying down debt and growing the Bitcoin balance.
And Brian, to add on that, at tail end here, the tail end of the comment was, about buying back shares. And, from our point of view, with a 53% margin to produce Bitcoin, which we think is, current, I'm going to step back. The way we think about Bitcoin is there's going to be half the amount of Bitcoin produced every day in the world in 3 years. And as a result, there's no better time to acquire Bitcoin than right now. And so we are prioritizing that. Yes, we are putting some of that back in the market, but, we really believe that Bitcoin is the right place to do it. And as we roll Bitcoin into more Bitcoin via investing in CapEx, that of course then gets us more Bitcoin is the way we're thinking about it. So as of right now, at the current market price of Bitcoin, we're going to continue investing in things that get us more Bitcoin. It's always an option, and optionality is one of the things I referenced is in my talking points. That's how we view it. We have flexibility, we have optionality. There's nothing that says we can't do it, but as we sit here today, that's how we're thinking about it.
Yeah, very good. And just as a follow up to some of the comments that you made on the facility, do you think we'll see more Bitcoin-backed facilities in the future? And as mining operations proceed to the next halving, do you think this is call it the way forward for the business, not just your business but the sector in general?
Yeah. Look, we had a market clearing exercise when we went out and looked at really upsizing the Coinbase line of credit. They had really the best cost of capital, and we received a lot of inbounds after our press release. So I would tell you that yes, there's a lot of capital that wants to be deployed out there using Bitcoin as collateral.
Great. Just one final one, if I may. As you look out in the market, there are many of your competitors that are trying to pivot to HPC. What does the market look like for bolt-on acquisitions and M&A in general for mining operations? Is that something that would interest you?
Yeah, absolutely. We're the most active acquirer for the last couple of years. Last year it was mostly private companies. We of course did do one public company last year, but in addition to Grid, we did 6 private acquisitions. So bolt-on acquisitions are something we're always open to, especially when valuations are advantageous. And we do think that, depending on how the market goes and, if there's tariffs and different the cost of actual mining rigs in any areas, great opportunity for us to come and capture some of that market share with, as we said earlier, beyond 50, we already have 7 exahash of rigs that we've largely brought stateside. So absolutely, just like always, our highest and best interest is of empty shelves and high quality infrastructure. So I do think that there will be opportunities. So and we look forward to some of our peers as they exit. We're always willing to take the phone call.
Great. Thanks very much.
Your next question comes from the line of Paul Golding with Macquarie Capital. Your line is open.
Thanks so much. For Zach or Gary, I just wanted to drill down a little bit more on the incremental capacity that you've paid for ahead of or past the 50 exahash goal. How much of that capacity is liquid cooled versus air cooled? And are you making new or different determinations as to the type of infrastructure and cooling that you're rolling out because of the tariff dynamics? Not to say that is a hindrance to deploying the capacity, but just how you're thinking about that and whether that might have an impact on efficiency going forward or any other impact operationally. Congrats on the quarter otherwise. Thanks.
Hey, thank you, Paul, for joining. I would say when you look at the prepaid amount on the infrastructure, it really all relates to immersion cooling. We think that it is still the best path forward. The majority of the rigs that we've also brought in country related to that are also immersion cooled. Now we have brought over, the latest gen also air cooled to, fit into tuck-in acquisitions and other similar opportunities because that's often readily available on the market. But on our ground up builds, we are committed into the future, into immersion cooled, because we think it provides the optionality that will be necessary in the next 3 to 5 years in particular, and into the next halving.
Thanks. And I guess this is just a quick follow-up. Are you seeing any impact to putting on that as maybe not the immersion tanks given more direct-to-chip liquid cooling for AI, but some of the infrastructure around heat exchanging and pumps? Are you seeing any price impact from the demand that we're seeing in HPC and how that might be pressuring the products to enable this functionality in the space?
What I can say is in our supply chain, we are still the largest buyer because of our growth. A lot of, if you're an HPC group that wants to announce something you're going to do tomorrow, you're probably not purchasing still for a while as you work on your permits, your designs, your plans. As we all know, most HPC data centers take 3 to 5 years to build. So we are still well ahead of the curve, and we do buy our supply chain in advance. That has given us an advantageous place in line, is probably the way to say it, as we have demand for infrastructure.
Great color. Thanks so much.
Again, if you would like to ask a question, press star, then the number 1 on your telephone keypad. And your next question comes from the line of John Todaro with Needham & Company. Your line is open.
Hey guys, thanks for taking my question, and appreciate the commitment to limiting dilution. First question, just going back to Gary, some of your comments on the yield you could generate on Bitcoin, the treasury strategy. I mean, do you think we're getting to a point where it's fair for us to start forecasting out a yield on that? Any kind of guardrails? I know you laid out some, but it seems like it's still kind of up in the air. And then my next question is, and I guess I'd frame it almost the opposite way that other peers have asked it, but do you actually think, we keep hearing that major hyperscalers like Microsoft are actually kind of pulling back spend. Have you noticed it might be actually getting easier to find power in sites now, whether it's kind of a weekly or month-over-month basis? Any commentary there would be appreciated.
All right. Hey, John. Thanks for the question. I'll take the first part of that. When it comes to the yield, I mean, we're not prepared to give any guidance here. Again, we're in the crawl phase of the process. But I believe it was on the last call, we said that we're targeting like mid-single digits on an annualized basis for the entire Bitcoin balance. I think that's a reasonable yield to expect, again, on an annualized basis. Because, again, we want to make sure that the risk-reward relationship is well in balance, and we're not taking unnecessary risks and not getting a lot of reward for that. We want to make sure that it's very strategic and precise and really conservative. So internally, we're looking at that 4 to 6% range.
And I want to sort of address the access to power in HPC. I think it's important when you read in between the lines of what those headlines actually say. The hyperscalers are still committed to investing and building in that space. What they're spending less on is in co-location contracts, which is why we see it as incredibly dangerous for anybody and, frankly, reckless for anyone that goes out there and plans to build it without a customer that is ready to take that rack space, because they're already, canceling the soft commitments they have. And again, it's because they're doubling down on their builds. It's important to know because NVIDIA, for example, will come forward, and they've been very clear that the data center of yesterday is not a data center that works tomorrow. And I think that's what's driving the cancellations is the hyperscalers are well positioned to make the right investments and the right technology to build in what is going to be a new normal for data centers into the future. Density is getting to a point where there's going to be hundreds of thousands and even millions of square feet of empty data centers because the density can be tucked off into the corner. And if you built a data center 5 years ago, it's already obsolete. That is the reason why hyperscalers, we believe, are canceling their spend in co-location. So again, I don't think it's that power demand is going to go away. It's just where and how that demand comes to the market. Now, what we are seeing is in the areas we're operating, we are still finding access to power readily available and prevalent. And it's because how we find power in rural America, in the areas that the freeway went around and the rest of America forgot about. That is what makes our strategy successful.
Great. Thank you, guys. Appreciate it.
There are no further questions at this time. Harry, I turn the call back over to you.
Thank you again, Jeannie, and thanks to everybody for joining today's earnings call. We look forward to staying in touch and sharing future results with you in the coming quarters. Stay tuned for more groundbreaking achievements from the CleanSpark team, America's Bitcoin miner.
This concludes today's conference call. You may now disconnect.
In theory, get the benefit of both, but then that's just how the market happens to see us. Look at our big hodl, and they value us that way. We personally think that the company is obviously more valuable than that. As regards to the Bitcoin price action, if you would, many people have seen in the news lately. There's now 4 or 5 new companies that have announced that they intend to become Bitcoin treasury companies. You've seen that the state of New Hampshire has now approved their Bitcoin strategic reserve, and they will be actually investing in Bitcoin and buying it. The state of Arizona is going to allocate Bitcoin to the Bitcoin strategic reserve that they're creating that is in the possession of state government, law enforcement, and others. And I fully expect to see other states continue in this path of establishing strategic Bitcoin reserves. In the very near future here, we'll see the administration in Washington announce how much Bitcoin is going into the strategic reserve, because I believe we're coming up on the deadline for that. And I think we're starting to see continued good institutional inflows into the ETFs. And we're now seeing a number that was published earlier this week or last week that showed about 9% of existing Bitcoin is now held by corporates and ETFs. And so as that continues to happen, that's going to continue to drive the price of Bitcoin up. And so I believe that we are in a very different market regime than previous regimes where we had cycles that every 4 years Bitcoin would act based on halvings and minor productions. But if you look at the market today, even though most miners are selling and Mara is still doing a full hodl strategy, the price of Bitcoin is moving up. So there's clearly demand in excess of supply. And if you think of stock to flow ratios, 450 new Bitcoin being emitted a day. If every miner were selling Bitcoin, that would be 400 Bitcoin going into the market every day. And yet, a greater number than that are being purchased every day by just a handful of players. So I think we're going to continue to see things move up in Bitcoin longer term, which is why we are still in a very much a full hodl position.
Thanks. And I'd like to focus, I guess, my lead questions here on your off-grid expansion strategy. So first, on the types of off-grid sites Mara is prioritizing for future growth, can you elaborate on the public-private partnerships with governments and energy companies that you're currently in discussions with? And are you focusing more on flared gas or wind or other sources for new acquisitions and developments? Thanks.
Yeah. So if you think about what I said 4 years ago, I think it was at the Mining Disrupt conference in July of 2021, I said that Bitcoin miners are going to have to partner with energy companies, or energy companies were going to own them. And that is because I believe that eventually grid-attached Bitcoin mining, where you have a PPA and you're paying an average cost, which I believe today the average PPA for a Bitcoin miner is somewhere north of 4 cents a kilowatt hour, would not be tenable as you start getting out into the years of 2028 and the halving in 2032. And that you would have to partner with energy companies and find a different way to structure the business. So without divulging details, we are very much executing on that vision of partnering with energy companies. If you look at the Duke University study that was recently done, they published statistics basically saying that while the AI industry needs somewhere in excess of 40 gigawatts of power to deploy their growth plans, the U.S. energy grid has in excess of 70 gigawatts available if the load is willing to be flexible by a small percentage, which currently the AI industry is not. We believe that by bringing solutions for load balancing to the AI industry that will enable AI data centers to co-locate with Bitcoin miners, where Bitcoin miners provide the flexible load that enables AI data centers to operate as a flexible load on their grid, this will open up huge amounts of power to the AI industry. And as we start shifting to inference, or what is now more being called agentic AI, those types of data centers don't need 500, 600, 700 megawatts. They need less than 5, they need less than 50. These are much smaller data centers located in closer proximity to the customers that are operating them, primarily private cloud operations, near-prem or on-prem. So we believe that the future of energy is about partnering with energy companies where we can help them monetize every stranded electron or every underutilized electron. And if you look in markets like the Middle East, for example, when we started working in UAE, in the wintertime, they had upwards of 3 gigawatts of excess power available. And in the summertime, that dropped fairly dramatically. But since then, they have continued to add energy generating capacity. If you look at Saudi Arabia, they likely have 4 to 5 gigawatts of excess energy capacity today that could be made available and monetized and used. If you look in Europe, you have a similar situation. While people read in headlines about Spain and Portugal going offline due to grid instability issues, they have built out huge amounts of renewable energy, which is not really selling energy during a great portion of the year. And those are all electrons that are going underutilized. And so our focus is to work together with energy companies, work together with sovereigns and government entities to take advantage of all of those underutilized electrons by structuring business relationships that enable us to partner with them on a long-term basis to build, operate, and manage essentially flexible loads that can help monetize that stranded energy. As you look at the mix, what you're going to find is a mix of thermal, a mix of wind, solar, and some flare gas. It really depends on the market and the partner. We're in discussions with some of the largest energy companies in the world that have a mix of all those energy sources and nuclear. And their concern is one of how do they balance load on a grid, how do they deploy flexible base load, and how do they monetize from behind the meter at renewable sites the electrons they can't sell today. And so you'll continue to be applicable to this method. And what I think you'll see us doing more and more in the future is as we continue to work with especially oil and gas producers, you'll see chunks of this flare gas type generation come online in different parts of the world where we're able to deploy our Bitcoin mining operations as a way to monetize that stranded gas. And we're super excited about those opportunities. But I think the message here is expect us to grow aggressively in partnership with these public and private entities across the world. And as you may recall, one of our goals, stated goals, was to grow our international business such that we had about a 50-50 mix between U.S. and international. And we'll continue to do that. And we believe that is a great way of delivering on growing U.S. hash rate, because even though we operate outside the U.S., it doesn't mean we won't be pointing that hash rate back to U.S. controlled pools. So we're very excited about being able to contribute to U.S. global mining share growth across all the countries that we mine in.
Thanks, Fred. And any guidance on the timeline of when we should expect those partnerships to start coming to fruition? Like, is that over the course of 25 starting, or is that, you know, I know it's a 3-year target that you're looking at, but just any context you could provide there.
You know, we purposely not wanted to guide to exahash numbers, because what that does is causes the market to look at us chasing a specific number and delivering on a certain time. And when you're working with these large government and energy majors, things can take longer than one thinks. I think what I can say, though, is that you will see good progress this year and some announcements that will give an indication of the potential of what's going to happen over the next few years. And I think you'll see us showing up at events in places where other miners normally wouldn't be, as we talk to these partners.
Thank you. And maybe this one for Salman or Fred, whoever wants to take it. You know, Mara reported a hash cost of 2.85 cents per terahash in Q1, and that's, I think, marks 4 consecutive quarters of sequential improvement. As you continue to expand this off-grid power capacity, how do you expect this to impact your hash cost position over the next 3 years?
Salman, you want to take that?
Yes, sure. So, Stephen, as you mentioned, we have sequentially reduced our hash cost, and our eyes have been fixated on capital and operational efficiencies. And that result is showing up in our historical P&L. As we have stated in the past, we expect our hash costs to continue to decline over a period of time. And those are as a result of actionable projects that we have worked on. Some of those that you have seen publicly announced, and others, as Fred mentioned, are in the pipeline. As we move forward from here, we expect the Bitcoin mining to be, this sector, every 4 years there's a halving event that happens, and the expectation is the Bitcoin price is going to go up. We are building our company in a position where we don't have to rely on the Bitcoin price or hash price to continue to go up. We expect it to go up, and we expect it to create significant value for us, but we are prepared for the downside situation, and that's why it's very important for us to be sourcing megawatts that are closer to the low-cost environment. For example, the 2 announcements that we had in Q1, the 139 megawatts generation of electricity from our own source. One of them is the wind farm in Texas, and that's about 114 megawatt plant, and that results in a significant reduction in our cost, because we consume electricity during the time when the wind blows and when the grid is congested, and the grid loves that because we are able to decongest the grid while hashing at the peak hours, and we don't have to mine when the electricity is expensive. So that's the kind of model that helps us drive our costs down. One point that I want to mention is that while the sector is focused on specific KPIs, for example, some companies, some of our peers are very focused on joules per terahash. Some of them are very focused on uptime. No doubt that these are important metrics, but you have to view what value does that create for your stockholders. And our focus is the value creation for our stockholders. The uptime could be compromised for that. The joules per terahash could be lower depending on the pricing where you get there, as long as it creates the most value for our stockholders. And that's where our eyes are focused on, and that's exactly what we believe is going to drive our hash costs further down from here.
Yeah.
Great, thank you.
You can think of it as when you have your own generation and your energy price is, substantially lower than 3 or 2 cents a kilowatt hour. then all of a sudden it opens up the ability to use maybe slightly less efficient machines, as Salman said. And if we're able to deprecate machines that have already been fully depreciated from our grid attached sites and reuse those behind the meter at these intermittent sites, your hash cost drops very significantly. And you don't have the need to operate 99% of the uptime because the machines are already depreciated, and so they've already been paid for. And so every kilowatt hour you can operate, especially that you can operate at these low power costs, is a profitable hour. And so we believe that over time, as we continue to grow this fleet of what we call our AARP fleet, our advanced ASIC replacement fleet or retirement fleet, then that will have a very positive impact on the overall hash cost going forward. It also gives us a secondary advantage, which is, if you're only doing grid attached like some of our peers do, every 3 or 4 years, you have to replace your fleet to stay competitive because you're paying a fixed price PPA, and potentially even that energy cost is going up due to demand on the grid. And then you sell off those machines and you buy new machines. By being able to retire our machines into a graceful program of retirement at these behind the meter sites, our hash rate isn't decreased in the same way that our peers is, where they're having to do net zero replacements. We're able to maintain a certain amount of hash rate and buy incremental hash rate to add that. It also gives us the ability to even buy other people's retired machines. And if you can buy a machine that is only a third less efficient than a state-of-the-art machine, but you're only going to pay a third of the price for it, that's actually very beneficial. So we believe this is the right strategy going forward as we continue to scale.
Thank you. And can you address sort of the concerns that lower hash cost for the off-grid mining may be offset by trade-offs like reduced, and you kind of touched on this, reduced rig uptime, higher operational expenses, and elevated capital expenditures? Sort of maybe how do you see the IRR for off-grid Bitcoin mining sites compared to grid-connected sites? And I know you touched on some of the economics of the wind farm in the shareholder letter, so maybe just elaborate on that.
Yes, I think if you look at, in the case of the wind farm, for example, the infrastructure cost, as stated in the shareholder letters, I think about 150 to 160K per megawatt, which is substantially less than what you would be paying in a traditional grid attached, because we're able to use these, let's just call it retired infrastructure, meaning miners and containers, et cetera. And when you marry that with, at a wind farm, you don't have an input cost for your energy, right? At a wind farm, your energy cost marginally is, just to put a number out there, say 1 cent per kilowatt hour for your O&M. That essentially gives you, best-in-class operating cost when you look at the minimal cost of the infrastructure and the power cost. So if you can operate 60% of the time, that's a great opportunity right there. If you can operate 70% of the time, it's amazing. And some of these wind assets have fairly good uptime, which allows you to operate that way. In the case of the flare gas, you're operating 24/7 at very low cost. And so those types of sites are, again, very profitable. And as you go to these public-private partnerships, you can operate intermittently, especially if the price of energy that you're paying is similar to that of a wind farm or a flare gas site. So we believe that this concept of Bitcoin going from being a 99% uptime operation to becoming more of an intermittent operation that's able to shape load to meet the demands of the energy companies, you become a very attractive partner for the energy companies. But it also requires that you have systems that allow you to shape your load to the energy companies supply. And that's been a big focus of our technology team over the past year.
Thanks, Fred.
Just to add to that, the AARP program that we talked about earlier, the IRRs for those are significantly higher than a traditional model. And even with the depressed hash price assumption, we expect the IRRs to be in the range of 30 to 40%. And this is the depressed in price environment on the hash price, so very conservative. When it comes to the cost per coin or energy cost, you think about, Fred mentioned electricity costs about $40 per megawatt hour. All-in cost probably $50, $55 per megawatt hour for traditional Bitcoin mining out there today. For the AARP program, we expect that to be approximately all-in cost, operating cost, around $10 per megawatt hour. So as you can see, we're systematically going into the direction of going closer to the lower cost operations that will drive our costs further down from here, as we had talked about previously.
Thanks, Solomon. I want to turn to AI real quick and the 2PIC. I mean, can you maybe share more early market feedback from your 30 megawatt 2PIC immersion pilot project and what's going on there? And then what specific revenue opportunities do you see emerging from commercial deployments of 2PIC and AI data centers?
Sure. So the 2PIC deployments we've done to date have been done with Bitcoin mining operations. And that's kind of an ideal way to wring out any bugs, if you would, of these systems. And what we're finding there is that we have an ability to substantially overclock systems. So, if you think of it this way, if you need 100 miners operating at nameplate capacity to essentially operate a site, and you have the ability to overclock them by 50%, it means you could reduce the number of miners you actually have to buy by a third. And miners being one of the most expensive components in a deployment, that CapEx savings is substantial. And the savings is significantly outweighs any marginal increase in cost of the two-phase immersion costs. In AI, it's even more that way because of your ability to overclock your GPUs. As you start moving to 1 kilowatt chips in AI, you have to move to new types of cooling technology. And we are specifically designing two-phase liquid cold plate technology, which is a plug-in replacement essentially to existing solutions today. So that we'll have a cooling technology that helps people deploying AI to transition from rack mount systems over time to two-phase liquid immersion technology. But they'll be able to begin using our liquid cold plate solutions today to lower the costs of their cooling. And again, we don't use water in our systems, and so we are environmentally friendlier in those spaces. And we fully expect to see some really exciting opportunities there. We're currently deploying, getting ready to deploy pilots with multiple compute OEMs on the AI side, testing solutions across a broad set of applications and configurations, such that we're able to really characterize the benefits for each of these OEMs. In the AI market, we believe the key thing is to partner with the compute OEMs such that they use you as the reference of what people should use for cooling. It dramatically decreases the sales friction and dramatically increases the potential demand for the product. And 2PIC is only one of the many solutions we intend to bring to the AI and digital infrastructure market. Over time, it's our intention to deploy a broader swath of solutions and services to them, such that they can leverage things like our power management capabilities, orchestration, and other things. So we're very excited about what this market is going to bring. And we think 2PIC and our liquid cold plate solutions are a great market entry vehicle for us as the AI technology industry continues to develop and as they advance into hotter and hotter processors.
Thanks, Fred. And I want to touch on a couple things here. I know I have some limited time, but one, I mean, maybe just wrapping it all together. So you recently did the Auradine Series C funding round. I was wondering if you can maybe, if you can disclose your ownership stake there, and if you're interested in pursuing a majority position or potential vertical integration in the future. One, and then around this, maybe just talk about how the tariffs imposed by the Trump administration are impacting, procuring mining rigs. I think you spent about $136 million in CapEx in Q1. It's split roughly 70-30 between rigs and infrastructure. So maybe just if you can combine all that into one, thank you.
Sure. As it relates to Auradine, we own a little under 15% of the company today. And, one of the reasons we were very involved in founding the company was because developing semiconductors is very expensive, and we felt it would be best done leveraging institutional investment dollars. And today, the investors in Auradine include people like Mayfield, Celesta, Samsung, and many others. And one of the board members on that serves together with me on Auradine's board is Lip-Bu, the CEO of Intel. So Auradine is very focused on solutions outside of Bitcoin mining as well. The Bitcoin mining chip, which we're the predominant customer of, is amazing, very power efficient, and has a set of features that allow us to do all sorts of very special things in relation to dealing with the energy efficiency and how the chip operates towards a set target, whether that be hash rate, energy efficiency, or maximal Bitcoin production. Other things that Auradine are doing relate to, which they've announced, relate to AI infrastructure technology around network switches, which is a super exciting product. Auradine has already spun off an AI security technology business, and if they keep doing the great job that they're doing, it's going to be a very valuable investment for Mara to have. But it's not something we'll make captive anytime soon. It just doesn't make sense for us. As you look at other aspects of tariffs and things like that, as we mentioned in the shareholder letter, we've now begun manufacturing our own miners. And obviously, we've been working to develop a supply chain around that that enables us to optimize and have agility, if you would, in what we're doing, such that we're minimizing as much as we possibly can the impact of tariffs. And if you think about a miner, the vast majority of the cost of a Bitcoin miner are the ASICs. And so, again, the relationship we have with Auradine gives us the opportunity to keep our costs down and control the supply chain such that we can ensure our own supply, but more importantly, we can minimize the impact of tariffs. As it relates to the infrastructure that we use, it is going to have an impact, obviously. Steel, metal, things that you use to do containerized solutions are impacted by tariffs, and I think will be impacted in that area the same as anybody else would. But again, we have a very strong supply chain team that work for us, and especially with 2PIC and building our own technology solutions around containerization infrastructure, we're going to optimize on a continual basis according to how tariffs go. I think my personal belief is that I think we'll see trade deals announced on kind of a continual basis here over the next months that will ameliorate a lot of the concerns for industries. But I think that there will continue to be a challenge with tariffs related to China, and I think that the more that you can source outside of China, the better things will be. And then just lastly, on the topic of tariffs, as we continue to grow our business outside of the U.S., that's a very different tariff picture when you're buying miners or you're buying infrastructure and you're having that delivered somewhere outside the U.S. So.
Thanks, Fred. So in March, MARA established a new $2 billion at-the-market equity facility. And I was hoping you could discuss sort of the strategic rationale for choosing an ATM program over taking on, maybe additional leverage, and outline your priorities for deploying, these funds in 25 and beyond.
Salman, you want to take that?
Stephen, when you think, yeah, sure. When you think about the source of capital for this sector and for MARA in general, it's been predominantly ATM dependent over the last few years with some converts and in our history we have done some converts back in 2021 and put some leverage on the balance sheet and bought Bitcoin.